There is a particular kind of quiet that settles over a household when the money in the wallet still looks the same but somehow buys less than it did a few months earlier. And this is the quiet that fell over millions of homes in the early 1970s. Not because anyone had lost their job or made a reckless decision, but because the value hidden inside the currency itself had begun to erode, slowly at first, and then with a speed that outpaced almost every plan people had made. A family might have felt, in 1971, that they were doing everything right, saving a portion of their income, paying down a mortgage at a fixed rate, buying groceries from the same store every week. And yet, within a few short years, the same grocery list that once cost a certain amount had climbed so steadily that the increase itself became the topic of dinner conversations, not because people were poor, but because the ground beneath their financial decisions had shifted without their consent. To understand why this happened, it helps to step back from the emotional experience of inflation and look instead at the mechanical explanation, because inflation is not simply prices rising for no reason, it is, at its core, a mathematical relationship between the amount of currency circulating in an economy and the amount of goods and services that currency is chasing. When the supply of money grows faster than the production of real goods, each unit of that money represents a smaller claim on the world's limited resources. And so, prices rise, not because goods became more valuable, but because the money used to buy them became less valuable. In the early 1970s, this dynamic accelerated for several intertwined reasons, including a significant expansion of the money supply, the decision to sever the direct link between the dollar and gold, and a sudden oil price shock that rippled through nearly every sector of the economy, since virtually everything, from transportation to manufacturing to heating homes, depended on energy. What made this period especially disorienting was not simply that prices rose, but that wages struggled to keep pace, creating what economists came to call stagflation, a combination of stagnant economic growth and persistent inflation that defied the conventional wisdom of the time, which held that these two forces should not occur together. For the average household, this meant a strange and uncomfortable sensation. Watching your paycheck's nominal number stay roughly the same or grow only slightly while its purchasing power quietly diminished month after month. And this gap between what a dollar could once do and what a dollar could now do became a kind of hidden tax that no one had voted for and no one could easily escape. The psychological dimension of this era is perhaps even more instructive than the economic one, because it reveals something enduring about how humans relate to money. People tend to anchor their sense of value to the numbers they see, rather than the purchasing power those numbers represent. So a raise that technically kept pace with inflation could still feel like a loss. And a savings account that grew in nominal terms could still be shrinking in real terms without the saver ever noticing the erosion until it was substantial. This is sometimes referred to as money illusion, the tendency to think in terms of face value rather than actual value, and it explains why inflation can feel like a betrayal even when, on paper, income appears stable or growing. Zooming out from the individual household to the systemic level, the 1970s reveal something important about how modern economies are structured, which is that the value of currency itself is not a fixed, unchanging fact of nature, but a managed and sometimes fragile agreement between central banks, governments, and the collective trust of everyone using that currency. When that agreement is strained, whether by excessive money creation, external shocks like energy crises, or shifts in global monetary policy, the effects do not stay contained to abstract financial reports. They travel directly into grocery bills, rent payments, and the quiet arithmetic that every household performs at the end of each month. This is why economists and historians often return to this decade when trying to explain why inflation, even at seemingly modest annual percentages, can compound into a very different financial reality over just a few years, since the same mathematical principle that makes compound interest powerful in savings also makes compounding inflation powerful in erosion, only working in the opposite direction, against the saver rather than for them. What ultimately shifts for those who study this period closely is not just their understanding of a specific decade, but their relationship to the idea of financial stability itself. There is a kind of identity shift that occurs when someone recognizes that the number printed on their paycheck or displayed in their bank account is not the same as the actual command that number holds over real goods and real time. And once this distinction becomes clear, it becomes difficult to think about saving, spending, or planning in purely nominal terms ever again. People who internalize this lesson tend to ask different questions, not simply, how much am I earning, but how much can this actually purchase? Not simply, how much have I saved, but how has that savings' real value moved over time? None of this is presented as a prediction of what will happen again, nor as a suggestion that any single strategy exists to fully insulate a person from these forces, since monetary systems are complex and shaped by decisions far beyond any individual's control. What the 1970s offer instead is a historical case study in how quietly and thoroughly the meaning of money can change, and how the gap between perception and reality can widen without dramatic warning signs. Only the slow accumulation of small differences between what things used to cost and what they cost now. Understanding this history does not grant immunity from future economic shifts, but it does offer something valuable, a more grounded and less illusioned way of interpreting the numbers that shape everyday financial life, an awareness that the currency in a wallet is not a fixed unit of value but a living, shifting agreement that deserves to be watched, questioned, and understood rather than simply trusted by default.